it's all about thinking probabilistically. And so whenever you put on a 0DT trade, a 1DT trade, or a 7DT trade, you're not only going by the deltas. I remember someone asked a question last week when Owanza was teaching. I think it wasn't last week, it was Tuesday. And he was talking about that the percentage from at the money is just another gauge. Someone say, why can't you just look at delta? The percentage at the money is another gauge. It's like having different gauges in your car, right? Some of them might, kind of overlap, but it's giving you a little bit more information. And so the percentage is giving you kind of information to let you think, okay, I know it's saying a 5 delta, but let's just say that 5 delta is 1.5% away. Can we drop in this current environment 1.5%? And then most of us would say yes, right? We can easily drop that in a day. So you don't want to be fooled by deltas. You don't want to be fooled by randomness. Do they work based on the percentages of the one standard deviation, two standard deviation, three standard? Yes, they do. You still don't want to just solely depend on it, in my opinion, right? I know seatbelts work, but I'm not going to solely depend on the seatbelt. I'd rather have a car with an airbag too. But it's true, right? I'd rather have more safety measures to make sure that I can, survive. Or thinking about things probabilistically can help you do that. And being realistic. Can X happen? Can Y happen? When we're putting on a 70T trade, and let's just say we were going to do one right now, we're obviously going to check the economic calendar. If you go check the calendar, it's going to tell you that it's a green light, right? It's none of the things that we worry about, which is three things right now: CPI, unemployment news, and the Fed interest rate decision. None of those are happening next week. We do have the PCE happening, but we don't worry about that one. But you can be vigilant about it. And then let's say if you worry, you can decide, okay, I'm going to do a 7, but get out before then, or I can do a 6 and make sure I never even have to go into a 0DT trade. You can do that. But for me, if I was doing this trade, I would do a 7 and it's a green light. Then I would come in here and look at the straddle price. This is giving me the 2 standard deviation or the 1 standard deviation move here for right now, but we want to get 2 standard deviations. And the reason why we do 2 standard deviations, you guys, not because it's got a 95% chance of winning, because we're not at expiration, because we're not going to hold it to expiration. That's not our plan. That's never our plan to hold these 70T trades to expiration. We do the 2 standard deviation move so that it can allow us to hold the trade, not only having a high probability of winning, but it allows us to hold the trade because we're basing it on probability of touch and not just probability of winning at expiration, because that's what options are based on. They're based on the probability of winning at expiration at the exact time of expiration. But we know that markets can move up and down just like they have today. We were up 30 plus points, and at one point we were down 30 plus points. That's movement. I wouldn't be surprised in the next 20 minutes we end flat. That's a lot of movement within a time frame, and that's definitely going to happen in the next 7 days. But if you can be as far away as possible, it can allow you to withstand a lot of movement without having to do anything, without having to make an adjustment. But if you do have to make an adjustment, ideally be making that adjustment, or most of the time I should say, be making that adjustment way before it's a huge problem because of the other kind of risk measurements we put in place. And that's the green zone, yellow zone, and red zone. We're not waiting to it goes into money. We're not waiting till it's close to at the money. We're trying to adjust that with still a lot of wiggle room to give us more wiggle room for the market to continue to go against us if it does. So it's always thinking about it probabilistically. And so the rules of setting up this trade is helping you do that. But you have to also kind of have your assumption. You have to have your opinion, have your take. Years ago, there used to be a famous kind of sports guy named Jim Rome. And he used to, for some reason, I always remember he used to always say, have a take and don't suck. And so you call on his show, and if you had an opinion, he thought it sucked, he would tell you about it. So I thought it was, rude, but an interesting kind of, you know, show that he had. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. And so that's what you need to have when you're trading. You always need to have an assumption, but don't be dogmatic about that assumption. So in this case, I'm going to make my assumption. Mine right now is that the velocity of risk is to the downside right now. It's more risk of running into a big problem that it's going to be harder to adjust perhaps. It's going to be to the downside. So if I take this and I say I just round it up and say 107 and I times it by 2, we're going to say this is 214. So what we're going to try to do is set this up and be 214 points away on the put side and the call side, at least right now. And then we kind of skew it based on that assumption. My assumption is that the risk is to the downside. Right? So if I take that 59.59 and I minus 214 from it, that's going to take us to 57.45. So let's go all the way down to 57.45. That is an 11 delta. We have another risk measurement that tells us we do not want to be any higher than a 10 delta. So I already know I'm not going to put this on at 47.45, even though it's 2 times the straddle expected move. So I'm going to move this further. So let's just say I decided I'm going to move this to this 9 delta here, about 20, 25 points lower. And I'm going to do a 10-point wide spread. And then on the call side, I'm going to take the 59.59 and add 214 to it. And that's going to take me to the 61.73. So let's just say the 61.70. So I'm going to go there, and that's a 1 delta. You know I'm not going to stay there because the all-time high is 61.47. And I don't think we're going there in the next 7 days. So I need to collect at least $100 after fees and commissions. I'm only getting 75 here. I don't want to really move that put side. So what I'm going to do is move up this call side. And so let's say I move the call side up to the 61.45. Let's just see what that looks like. Well, that's not going to give it to me. Right? That's not going to give it to me. That's going to give me close, but it's still not going to give it to me. So if I'm going to do this, in my opinion, I would go higher than what the all-time high is, or within the all-time high, I guess, because the all-time high is 61.47. So I'm going to have to go higher than that. So let's say I went to this 6 delta here, and then boom, that's going to do it for me. But maybe I can go to this 5 delta. That's going to do it for me. As long as I get 110, I'm going to get $100 after fees and commissions. So I probably have to be somewhere around here. And just keep in mind, if we jump up, I'm going to be able to handle this call side. It's not going to jump up in a way that I can't handle it. Because even if we jumped up 100 points and we went to 6,100, I'm still not going to be in the money, and I'm going to be able to handle that. I still have the adjusting techniques that we talk about in the course. So it's going to have to be an extraordinary move to the upside to beat me. It's going to have to be a really phenomenal move to the downside to beat me. But it's more likely that that downside move could happen than the upside, in my opinion. So that's my assumption. So I'm skewed that way. I'm inside of 2 standard deviations or 2 expected moves on the call side, but I'm further than that on the put side because that is my assumption. So if I was putting this trade on right this second, this is how I would initiate this trade and feel fairly comfortable about it. Very comfortable about the call side and comfortable about the put side. Understanding the dynamics of putting on the trade, that's what you can control completely. You do not want to mishandle or screw up putting it on initially. Going to happen. You're going to put the trade on and something's going to happen like what it did right now. We just rang the register. Awesome. All right, Dr. Christina, we're going to put this, I got filled at 50. Maybe you did too. And
I
so
did
I'm going
too.
to,
Yep.
okay, perfect. So I'm going to go and do it again. So 61.10, 61.30, right? Or
Yep.
was it
30 and
61.30? And
61,
okay.
30, 40.
And the put side was what? Is it 50?
57, 20, and
Okay,
57,
perfect.
10.
Perfect. Thank you.
It
All right.
looks
So,
like it's going for 115.
all right. So let's get filled then. I'm going to do 2 contracts again.
Yep.
And let's try to, let's put in at one. I'm going to put in at 110 because it looks like you might not give it to me for 115. I'm going to put in at 110
Okay.
and see if they give it to us. We're going to give it a 2 minutes. And if they don't give it to me, I'm going to move the call side 15 points wide. I'm not going to move it up anymore, but I'm going to move the
Yep.
call side 15 points wide. So some of you probably thought that I was being a little facetious, but we could go green by the end of this. It's 5 minutes. A lot can happen in 5 minutes, but it's nice how we kind of bounce back up. That's great. And that's another 7DT trade off the board. And we're going to try to get filled on this other one here. We're going to give it a second. I'm going to give it 2 minutes, and now I'm going to come in and we're going to just do a cancel replace order and make it. I'm going to make the call side 15 points wide, so I don't have to move it any higher and not have to move the put side higher. And if the market jumps up on Monday, then it jumps up. Once again, you just trying to probabilistically place the trade the best you can and put it in a situation where, okay, if I am wrong about my assumption, I should be able to easily deal with the call side. I don't think we're going
Would
to run
you
away to the
would
call side.
would you move the short call to 61.35 to do 15 and still get
Well,
like
let's see.
20
Let's see. We
or
could do that. I
115?
was going to keep it at the 161.30, but let's see. So if we did that, that's 75, and we did it on the put side, that would be here. That would be 120. You can do that and still get it, but it looks like maybe it might be tough. I mean, right
Oh,
now, we can get 110 still. So we did the same strike and just did 15 point wide. In this case, we can probably wind up with 130, 115, 120
Oh,
in
that's cool.
premium. And I'm okay with that too. So
Yeah.
my timer is saying we got about 14 seconds. So I'm going to let that play out for a second. And because we might get filled with the current trade and we'll live with that. But I think it's good. I mean, we did the best due diligence we can do. I don't think the market is just going to tank if we bomb Iran. And if I'm wrong, then we do have two big adjustments in our arsenal. So it's going to have to be really substantially wrong. And obviously that's a possibility, but we're playing the odds. All right. So that's the end of that. We're going to cancel this. We didn't get filled. I'm going to go back over here and replace the order. And then I'm going to make the call side that. I'm going to put it at 125. I know I'm doing this fast. And we got filled at 125.